Here's why TQQQ versus QLD matters right now. Institutional investors are recalibrating exposure to leveraged ETFs amid shifting risk appetites. Today's market dynamics, gold surging, the S&P 500 climbing, and Bitcoin holding steady, signal a complex environment where volatility and yield converge. The debate centers on two heavyweights, TQQQ, the 3x leveraged S&P 500 ETF, and QLD, the 2x leveraged NASDAQ 100 fund. Both trade at multi-year lows, but their paths diverge sharply. TQQQ benefits from broad equity strength, while QLD hinges on tech sector momentum, a fragile proposition given recent earnings pressures. Context is critical. Global central banks remain cautious, balancing inflation concerns with growth preservation. The Federal Reserve's pause on rate hikes has emboldened risk-on sentiment, yet uncertainty lingers over geopolitical tensions and corporate profit margins. This ambiguity amplifies the appeal of leveraged products for those seeking amplified returns or downside protection. For long-term investors, the inflationary backdrop complicates decisions. Gold's rally reflects safe haven demand, while equities like the S&P 500 hint at a gradual recovery. However, leveraged ETFs amplify both gains and losses. Traders must weigh the cost of leverage against the probability of directional moves, especially in a low volatility environment. Raymond swing levels suggest caution. TQQQ's 3x exposure makes it vulnerable to even minor corrections, whereas QLD's narrower leverage may offer more stability. Yet, both face liquidity risks if retail inflows stall. Institutional buyers should prioritize quality over speed, aligning positions with macro narratives rather than short-term noise. If this analysis was valuable, subscribe for more institutional insights. Link in bio.